everyone, welcome back to Learn Wealthy. Inflation is back. Today we're diving into the latest consumer price index, the CPI report, and what it means for you and the economy. The CPI measures the average change over time in the prices paid by urban consumers for a market basket of goods and services. It's a key indicator of inflation, reflecting the cost of living. The report came out from the BLS yesterday, and it's for October 2024. The CPI rose by 2.6%. Compared to the same month last year, it's up from 2.4%. On a monthly basis, prices increased by 0.2%, consistent with the previous month. Core inflation, which excludes volatile food and energy prices, remained steady at 3.3% year over year, with a 0.3% monthly increase. So, we know that the Federal Reserve closely monitors inflation to guide its monetary policy. The slight uptick in annual inflation suggests that while price increases are more modest, they persist above the Fed's 2% target. Okay, I know the Fed actually tracks the PCE, Personal Consumption Expenditure, which is another measure of inflation. But we're just talking about the CPI for now, since it just came out yesterday. Whoa, hold on! Why do we need to know the CPI thing? Well, for those people with Fed-centric views, I guess you want to know what the Fed is going to do next. I think the Federal Reserve loves me, cares about me, thinks about me all the time. All right, man, you do you. But the Fed is always yapping about their 2% target, which is pretty BS if you ask me. If the Fed's target was 2%, which they never hit, why did the Fed cut 50 basis points last September 18? And why did they cut another 25% last week? I thought they want to hit the magical 2% number. For consumers, a 2.6% inflation rate means a gradual increase in the cost of goods and services, affecting purchasing power. Businesses may face higher input costs, which could impact profit margins and pricing strategies. We're going to talk about the PPI tomorrow, by the way, which is inflation on the wholesale side. Inflation for the cost of businesses to produce their goods and services, which will eventually get passed on to the consumer. The PPI numbers should be coming out today. Overall, it looks like the economy continues to grow, but the persistent inflation rate requires careful monitoring to ensure it doesn't hinder the economic stability. So, in my view, the Fed is just always reacting to the economy, and it's just pretending to be in control. I think we'll soon see or realize that we're still in a disinflationary period. You gotta consider, shelter is a big chunk of the CPI, something like 30%. Are house prices and rent really going up right now? From landlord to landlord, is it so easy for you to increase rent right now? And if you watched my previous video, last month's US real estate market update, and the other one, Houston, Texas real estate market update, since I'm here, a realtor in Houston, Texas, you'll see that inventories are growing everywhere and demand is getting weaker. So I think we'll soon see that we're still in this disinflationary period, because this is what we usually go through when the yield curve inverts and uninverts and we're headed for a recession. As you know, if you've been watching this channel, the yield curve was inverted for about 2 years, which was recently uninverted a few months ago, which historically signals a recession, and these recessions are disinflationary or even deflationary sometimes. There you go. Keep talking, you fear-mongering crash bros. You're all about the doom and gloom. And if you've been watching the channel, you know that global banks are interconnected in terms of the ledgers of their commercial banks. Their central banks talk to each other, and global economies are interconnected through their trades. So when a major or a couple of major countries go into recession, usually the whole world goes into one. And China, Germany, some European countries, Japan, are all facing serious economic problems right now. They're either in recession or arguably in a recession. Also, if you understand how the money is made in the Eurodollar system, it's usually the commercial banks and not the Fed that generates loans and produces money. When banks are not lending and the overall systemic risk is high, they are not going to lend, no matter what the Fed pretends to do with their raising and lowering of interest rates. In summary, the latest CPI report indicates a modest rise in inflation, which the Federal Reserve and policymakers will need to consider in their economic strategies. And you should too. Staying informed about these changes helps us understand the broader economic landscape and its impact on our daily lives. My base case is the rate cutting cycle is not over because the unemployment rate is still going up and there's still a lot of risk in the economy. And regarding inflation, I think this modest inflation is just temporary and we're still headed for more disinflation. But then again, nothing is certain and we're just playing with probabilities. I'm not really a doom and gloomer or a recession bro. I'd rather think of myself as someone who wants to grab and is excited to grab opportunities. Stay tuned for the PPI report. It's coming out today, but we'll do a video about it tomorrow. And stay tuned for the Houston real estate market update and the USA real estate market update sometime next week. Thanks for tuning in to Learn Wealthy for finance, investing, real estate, and macroeconomics. Let's all learn wealthy together. I'll see you in the next video.